Tell me, in terms of risks, you mentioned one of them, and what I heard you say, Garth, is not making sure that, well, not having the right information, and in terms of advice, portfolio construction, et cetera, and that sort of, I just want to point out what I wrote down here. You said 85% of your return is going to be based on asset allocation, so it's quite important just to highlight that. But what are sort of 3 or 4 of the other risks that you think that people need to be aware of, or investors need to be aware of?
Information overload. Short-term commentators pushing agenda. I know that sounds like a strange risk, because we're actually talking about economic risk and things here. So that's one of my comments. A lot of your plans can be derailed by the guy on the radio on the way to work in the morning who says, something along the lines of, if I don't give my client 20%, he's marketing an agenda. So you've got to be very careful of greed, okay, and believing that the fundamentals will be different. Okay, they don't change, and no amount of analysis actually changes. All that's happening in our day and age is that information is moving very quickly, and it's changing the sentiment very quickly, but the macroeconomic fundamentals driving the world are very simple. So be careful of too much information. And if there's one thing people must understand, is when things are more expensive because of inflation, there's less money to invest. That means a person's going to buy what's essential, which translates to those companies that produce essentials are going to have a solid delivery. So not to break the rules of investing, okay? And to be aware of the changing planet. A lot of people have entered the investment markets over a very different cycle of quantitative easing, super low interest rates, super low inflation rates. This is the market that I know and understood pre-2008. And Anthony alluded to it. Be careful of, it all comes down to breaking the rules, but we are in a very different environment. And when we look at average returns, the risks you've got to be careful of is thinking that 30% is what your return should be annualized. Please understand, real returns are great if they're 5 to 7% above inflation. Those are stellar. But as inflation is higher, it still remains 5 to 7 above inflation. So the risks are unrealistic returns, okay? Influences are very fast-moving things that we've got used to that delivered massive returns. You've got to be realistic about returns. And, that's what Anthony spoke about. Active management, people being able to analyze real macroeconomic cycles that we're back in now, and being able to shift from what is expensive and what is run, and being able to pick out of the S&P 500 where, for example, the opportunities exist. Or like, our asset manager in China that can buy real companies and real pockets rather than just the thing. So you must do your research. You must speak to seasoned professionals. You must be very conscious of costs, okay, in investments, because the margins are going to get tighter. So you should be conscious of investment costs. You must be conscious of, do not enter anything that charges you upfront to allocate it. Because a reduced capital, be it tax or a commission or an upfront, is extremely damaging and so expensive over the long term. So try and get the highest net allocation to an investment. Be realistic about the returns. Understand what that asset class can produce. That's just the behavioral risk that I'm talking about. Anthony can talk about COVID risks, China going back into lockdown. I'm going to let him talk about some of those other risks there. Okay.
Sure. I would add one softer risk to that as well, is just understand the risk of not understanding your investment goalposts. And what I mean by that is you might find yourself in a situation where you can sustain yourself against your liabilities, and you take on undue risk because you don't quite understand your playing field. You feel you have to go into equities because everyone talks about equities, but you may not need to go into equities and have that kind of risk in your portfolio. Your portfolio might be able to sustain you without taking any undue risk. So I think it's important to understand your playing field as well. On a slightly more technical side, I think people need to keep in mind that the yield curve at the moment is inverted. It's traditionally been an early telltale sign of a recession. So that still exists, whilst the market seems to have forgotten about that as we hit the 1st of January. It's still there, it's still inverted. So be careful of that. Inflation numbers came out last night, slightly higher than expectations. They were down year on year, but there is a bit of a nastier, stickier side to that inflation that people are I wouldn't say not, they don't want to acknowledge it, but they're hoping it's going to come down. But if it doesn't, it could cause a lot of volatility. And then my third risk, I could probably talk for hours on this, but my third important risk would be understanding the interest rate cycle that the Federal Reserve is currently in. So the guidance was initially, guys have been pricing in the market that interest rates are going to be cut in the US by the end of this year. Our house view on that is that's quite, I think it's a bit premature. I think it'll probably start to happen next year. But really what that creates is it creates volatility in the market, because everyone's just trying to plot and forecast when these rates are going to come down. So I think a sustained period of higher interest rates is something to be cautious of. It's definitely a risk. Yeah.
Sorry, I'm making vociferous notes. I hope everyone else is. It's so much information. Yeah, I just keep thinking to myself, cross, I'm gonna have to watch this again to understand half of what you're saying.